ONEOK Incorporated, ticker OKE on the NYSE, a 50,000-mile pipeline network connecting the Williston Basin, Permian Basin, and Gulf Coast, earning fee-based revenue on every barrel that moves through its infrastructure.
Founded in 1906 as Oklahoma Natural Gas Company, headquartered in Tulsa, Oklahoma, 6,000 employees. After the 2023 Magellan acquisition, ONEOK is a multi-product midstream giant with $9 billion plus in combined EBITDA capacity.
Oklahoma Natural Gas Company was chartered in 1906 to supply natural gas to Oklahoma Territory homes and businesses. The company was renamed ONEOK in 1997 as it expanded beyond regulated utility origins into the midstream infrastructure business.
In 2006, ONEOK acquired Koch Industries' natural gas liquids business, doubling its NGL gathering and fractionation infrastructure and establishing the foundation of what became its core mass-capacity NGL network.
In 2017, ONEOK acquired ONEOK Partners, rolling the MLP back into the parent corporation and simplifying the structure for institutional investors who preferred a C corporation dividend over MLP distributions.
The 2023 acquisition of Magellan Midstream Partners for $18.8 billion added 9,700 miles of refined products pipeline, 54 marine terminals, and crude oil infrastructure, transforming ONEOK from a pure NGL company into a diversified midstream operator.
Pierce Norton became CEO in 2023, leading the integration of Magellan, the largest acquisition in ONEOK history. In 2024, the combined company passed a $9 billion EBITDA run rate, ahead of pre-acquisition targets.
ONEOK generated $18.9 billion in fiscal 2024 revenue. Natural gas liquids is the core, 59%. Natural gas gathering and processing adds 22%. Natural gas pipelines contribute 14%.
Adjusted EBITDA reached $6.2 billion in 2024, up 18% year over year. Fee-based revenue accounts for approximately 90% of adjusted EBITDA, cash flows tied to volume throughput rather than commodity prices.
ONEOK's 50,000-mile pipeline network spans the most productive onshore basins in North America. At today's construction costs and permitting timelines, replicating this network would take 15 to 20 years and tens of billions in capital.
ONEOK has maintained its dividend at $4.28 annually, yielding approximately 5.5%, supported by a 1.4 times dividend coverage ratio from distributable cash flow. The fee-based revenue model provides visibility to sustain this income through commodity cycles.
The dividend history shows the fee-based model in action. From 2019 through 2022, the dividend held flat at $3.74 as commodity markets experienced historic volatility. ONEOK then resumed increases in 2023 and 2024 after the Magellan integration.
On the competitive radar, ONEOK leads on acquisition integration at 88 and scores well on pipeline infrastructure at 85. Enterprise Products Partners leads on pipeline network scale at 95 and fee-based revenue mix at 90, the gold standard in midstream infrastructure.
Kinder Morgan leads on total pipeline network size, but scores lower on dividend strength. Williams Companies excels on fee-based revenue mix, but has less exposure to the NGL gathering and fractionation capacity that ONEOK dominates.
ONEOK's network covers 50,000 plus miles, with 1.1 million barrels per day of NGL fractionation capacity, 165 plus million barrels of storage capacity, and 54 marine terminals from the Magellan acquisition.
NGL volumes feed U.S. Gulf Coast petrochemical plants and LNG export terminals. The domestic chemical manufacturing renaissance and LNG export infrastructure build-out are secular tailwinds, increasing the volume-to-value conversion of ONEOK's existing infrastructure.
Pierce Norton holds a B.S. in petroleum engineering from the University of Oklahoma. He began at Burlington Resources and El Paso Energy before joining ONEOK in 2004 and leading the Williston Basin expansion.
Norton served as president and CEO of ONEOK Partners through the back-end growth phase, then as president and COO of ONEOK Inc. in 2021, before assuming the CEO role in 2023 and closing the Magellan acquisition. ONEOK moves natural gas liquids through 50,000 miles of pipe and collects a fee on every barrel. It doesn't matter whether commodity prices are high or low. It matters how much volume moves through the infrastructure, which means ONEOK's earnings are tied to the productivity of America's most active oil and gas basins.
The Magellan acquisition is the story right now. ONEOK paid $18.8 billion for a refined products pipeline network that dramatically diversifies its revenue mix. And if the combined EBITDA run rate of $9 billion materializes as management projects, the current stock price values the infrastructure at a significant discount to replacement cost. ONEOK just printed a quarter that makes the Magellan thesis look real. Adjusted EBITDA hit $1.997 billion, up 13% year over year, and management raised the full-year guide.
That's the headline for a midstream operator that traces its roots to 1906. Fee-based volumes are accelerating, and the integration synergies aren't a slide deck anymore. They're showing up in the numbers.
GAAP earnings came in at $1.23, just shy of the $1.26 estimate. But for pipeline names, the EBITDA print and the guide raise matter far more than a 2-cent EPS miss.
The big shift this quarter is that management raised full-year adjusted EBITDA guidance to a range of $8.5 billion, with a midpoint of $8.25 billion.
That's a meaningful upward revision, and it signals confidence that Magellan integration savings and Williston volume growth are tracking ahead of the original deal model.
Revenue of $9.618 billion blew past the $8.569 billion estimate, but remember, a chunk of that is commodity pass-through, so the EBITDA line is the cleaner read.
Net income of $776 million was up 12%, and EPS guidance now sits at a $5.53 midpoint, both consistent with the EBITDA strength flowing through to the bottom line.
Let's break the print apart. Adjusted EBITDA of $1.9997 billion, up 13% year over year, is the number midstream investors care about because it strips out the commodity noise running through the top line.
Revenue of $9.618 billion beat consensus by 12.2%. But again, fee-based midstream operators don't get rewarded for revenue beats driven by commodity pass-through. The market discounts that line item heavily.
GAAP EPS of $1.23 missed the $1.26 estimate by roughly 2.4%, which is a slight miss, and shares may see modest pressure on that headline despite the stronger underlying metrics.
Net income hit $776 million, up 12% year over year, which lines up cleanly with the EBITDA growth and confirms the operating leverage from Magellan is converting into real bottom-line dollars.
NGL volumes were up mid-single digits this quarter, driven by Williston Basin and Permian Basin producer activity, which is exactly the volume backdrop the bull case requires.
Refined products throughput is growing as Magellan integration unlocks new connectivity. That's the network effect management promised when they paid $18.8 billion for Magellan back in 2023.
Natural gas gathering and processing volumes also benefited from elevated producer activity in the same basins. So the volume story is broad-based, not concentrated in one geography.
And critically, none of this growth came from commodity prices. The fee per barrel and fee per BTU model held intact, exactly the way investors want it to.
The full-year guide of $8.5 billion adjusted EBITDA, with EPS of $5.53 and net income of $3.21 to $3.79 billion, is the clearest signal management gave the street.
That guide raise is what's likely to drive analyst target revisions in the coming days. When midstream operators raise the EBITDA bar, sell-side models follow.
Let's go deeper on the cash story. Free cash flow on a trailing 12-month basis is roughly $2.4 billion, and that needs to cover $2.9 billion in annual dividend payments at the current $4.28 per share rate.
On the surface, that's tight, but on a distributable cash flow basis, which is the proper midstream coverage metric, coverage remains above 1.0 times, which is what management has guided to.
Net debt sits at roughly $32.7 billion, elevated post-Magellan, and leverage is around 4.2 times net debt to EBITDA, which is at the higher end of the midstream peer range.
That leverage figure is the single biggest pushback from skeptics. The bull counter is that EBITDA growth and synergy capture should bring leverage back toward 3.5 times within 18 to 24 months.
On valuation, OKE trades at roughly 10 to 11 times forward EV to EBITDA, while midstream peers trade closer to 14 times, a meaningful discount to the group.
The forward EPS projection puts shares at roughly 16 times earnings, with a 5.5% dividend yield, which together suggest the market is pricing in execution risk on the Magellan synergies rather than rewarding the announced run rate.
If the $9 billion combined EBITDA run rate target materializes on schedule, the implied multiple compresses meaningfully, and that's where the re-rating thesis lives.
Stacked against the midstream majors, OKE's 10 to 11 times EV to EBITDA looks cheap. Enterprise Products Partners, Williams, and Kinder Morgan all trade meaningfully higher on the same metric.
The discount reflects two things: the digestion period for Magellan and the fact that OKE's leverage ratio is currently above where peers sit on a steady-state basis.
On dividend yield, OKE's 5.5% is competitive with the group, and the 1.4 times distribution coverage on a DCF basis is actually stronger than several peers can claim today.
The bull case argues that as integration completes and leverage normalizes, the valuation gap closes. And history says that's exactly how midstream re-ratings tend to play out post-acquisition.
The risks here are well defined. Number one is leverage. At 4.2 times, OKE has less balance sheet flexibility than peers, and any integration hiccup gets punished harder.
Number two is volume risk. Fee-based revenue is great when basins are active, but if Permian or Williston producer activity slows materially, throughput follows and EBITDA estimates need to come down.
Number three is the synergy capture itself. The $9 billion run rate target is management's own number, and the street is rightly demanding proof points each quarter before fully crediting it.
On options, the put-call ratio is 0.85, which is mildly bullish but not extreme, and implied volatility percentile sits at 45, suggesting the options market isn't pricing in any near-term shock.
There's no notable insider buying or selling to flag this quarter, which is a neutral signal, neither a vote of confidence nor a warning, just a quiet print from the C-suite.
Net-net, the risk profile is what you'd expect from a recently acquisitive midstream operator. Leverage and execution are the watch items, not commodity exposure.
Sell-side coverage breaks down to 17 buy ratings, 8 hold, and just 1 sell, with an average price target of $92 against a current quote near 86th.
That's roughly 7% upside on the consensus target before accounting for the 5.5% dividend yield. So total return potential on the consensus view sits comfortably in the low double digits.
Critically, those targets were set before today's guide raise, when management lifts full-year EBITDA guidance, analyst models update, and target prices typically follow within 1 to 2 weeks.
The buy-heavy distribution tells you the street already broadly believes the Magellan thesis. The question is just about pacing of the synergy capture and the leverage glide path.
For investors who already own the name, the guide raise is exactly the catalyst the bull case needed. The next quarterly print will test whether momentum continues.
The bull case is straightforward. OKE trades at a discount to rivals, including KMI, WMB, and EPD, while running an arguably better-positioned asset base post-Magellan integration.
Add in basin-driven volume growth, fee-based EBITDA up 13%, a guide raise, and a 5.5% dividend yielding well above treasuries. That combination is hard to find in midstream right now.
The bear case centers on leverage and execution. At 4.2 times net debt to EBITDA and $32.7 billion of net debt, the balance sheet has real obligations to service before equity holders see optionality.
The bear also points to the FCF to dividend math. $2.4 billion of free cash flow against $2.9 billion of dividends looks tight on a GAAP basis, even if DCF coverage holds above 1.0 times.
The reconciliation is timing. If synergies and volume growth deliver on schedule, leverage normalizes and the discount closes. If they slip, the dividend coverage debate resurfaces and the multiple stays compressed.
OKE delivered the quarter the bull case needed. Adjusted EBITDA up 13%, a full-year guide raise, and volumes growing across the key producing basins.
The risks are real. Leverage at 4.2 times and dividend coverage on a GAAP basis are the watch items. But the valuation discount to peers and the 5.5% yield make the risk-reward setup compelling for patient investors who can wait for synergies to land. Before we wrap up, a quick note. Charged Alpha does not provide investment advice. Everything you've heard today is for informational and entertainment purposes only.
We are not financial advisors, and nothing in this episode should be taken as a recommendation to buy, sell, or hold any security. Always do your own research and consult a qualified financial advisor before making investment decisions.
Ooh, we do! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.